Right, could you hear me now?
Right. Okay. I'm really sorry. We had a power outage living where we do. We have fantastic internet, except when we have a power outage. And I don't understand why. It's a beautiful day out there. It was very, very sudden. And this is the first time it's happened while we're doing a live stream. So we're really not sure what to do or how to respond. However, hopefully you can hear me and we can carry on. Where was I? Okay. We were looking at the 5 minute chart for the MNQ and discussing when you have a downtrend, what to look for as potential points of entry and also potential staging posts in the trend lower that would give you confidence to stay in the trend. And what we'll try and do is we will link this to the first bit of my analysis. We came to this point here, and I'm actually going to put it here so we can see this, what would have happened at the point where this candle was being formed. This is actually quite interesting because it's 10 minutes before the European Open. Here it says 6:50, 7 o'clock in the morning is our time in the UK. It's 8 o'clock in Europe. Is when Europe joins the market opens for futures and for forex. I mean, obviously there are traders trading before that, but 7 o'clock is the official opening time. And then what happens? We see a hammer. We had a lot of volume under that candle, but before that happened, we can see that volume there. But even that looks like a bit of an anomaly, doesn't it? Because you've got that candle and that candle the same size, and you have this massive amount of volume coming in. Volume price analysis is one thing. Is this spotting what we call these anomalies? Is where volume and price are in disharmony. And what we mean, as I said, by this is exactly that. It's a red flag. It's a pause point. It gives us a reason to think that looks a bit odd. And we also use what we call benchmarking, and that is we compare that price and volume relationship with that price and volume relationship. Well, if the price and volume took the price down by that amount of volume, what is that telling us? Well, two things. First of all, it is anomalous, but also telling us that there must be some buying coming in. It has to be. And then we get the hammer candle, which is a classic. It's an absolute classic. Hammers and upthrusts. Some people call them pin bars. You have this dip in the price, you have a recovery in price, and you have a lot of volume underneath it. Now, there is a danger. It is such a strong candle, but it is a danger. And the danger is this: because it is such a strong candle, the first reaction is, oh, that's it. I'm going to jump in. The price has finally found a bottom and it is going to reverse. Sometimes it does. You do get what we call a V shaped reaction. But because of the kind of environment that this market is trading in, it's very volatile. What has happened? It's not being driven by the sort of normal drivers, as it were. Really do have to wait. And you will find that. And what happens next? Yes, it does go higher. What happens in this candle here? But look at the volume underneath there. So by all means, this there is, you can call that stopping volume, to stop the fall that has been going on since when? Well, since midnight our time. That's not enough to stop it. That is the first. It's the first pass, if you like. And what happens when you get very strong trends to the downside, sometimes, and strong trends to the upside, where you get topping volume, is certainly to the downside, you have a lot of momentum. And you know what it's like, when you, I don't know, if you were running, and you want to come to a stop, you can't just stop immediately. It takes you a while to sort of, to stop that momentum. And that is what you have in the market. So what happens is you get that. You get a little bit there, and then you get this volatility candle. Now we know for the volatility candle on as much volume as we have over here. So something is going on, and we can. There's definitely effort coming in to try and halt this slide lower. Now with the volatility candle, and this triggers in real time, is we have an expectation that the price will revert into the spread of the candle. And what do we get? We do get that. I mean, that is encouraging, because from that signal, we think, oh, great, volatility candle, our expectation is being met. But more importantly, the volume under the green candles looks as though it is actually increasing, not by a lot, but by enough to give us maybe some confidence that, we are seeing some kind of reversal. And the reversal, the actual candle that we really want to see, is something like this, where you see you've got it in a downtrend, you've got the volume going up, and going back to this benchmarking idea, you've got a ton of volume under there, and you think, haha, because if that was selling, that candle should have been down there. So we had the first signal here, we had the volatility candle stopping it, if you like, price reversing inside. It gives us a kind of little floor. So we have this floor here, and we think, okay, well, if that breaks lower, that is going to go, that is that signal's not going to, isn't playing out. It's not a false signal, it's just it didn't play out. So you can draw a line under here if you like, and then we see this candle, and we see that amount, think, and what's more important is the next candle, the volume goes down, you have a green, you've got a wick to the bottom. Lower wicks are great, because the price support is coming in, and you've got price support there. And these two are really significant, because the selling pressure has dissipated. And then we start the climb higher. We've got that going, not by huge. I mean, this is an ongoing situation with what is happening from a geopolitical perspective, but from a trading perspective, this is what I was trying to say. Jumping in, rushing in, because everything is collapsing. There's fear. Yes, by all means, but you have to step back and take a very cool, clear look at what the chart and what the VPA is actually telling us. Right, I'm going to stop there. I'm going to pass over to David, because I know he's got lots of other charts that he wants to talk about as well. And I said, I do apologize about the sudden outage. We have been thinking about getting Starlink, and I think probably if this carries on much longer, it's probably not such a bad idea. So I'm going to pass over to David. And I'll stop sharing my screen, David. Is that okay? Yeah, okay. Where am I? I can't actually. Did you hear all that, by the way?
Yes.
Where's my Zoom? I can't actually find my. Oh my lord! Well, something's disappeared. Oh, wait a minute. I'm here. Hold on. Right. I do.
Unmute. Always works better if I switch the microphone on, I find. Unless I shout very loudly and hang out the window, but other than that, there we go. Hopefully you should be seeing my screen. You should be hearing me loud and clear. What you should be looking at is I've got the market strength indicator here on the right-hand side, which is running on 2 minutes, which you probably can't see because it's slightly off top screen. There we go. That's on 2 minutes. And then I've got 4 of the prime commodities. I've got gold, I've got silver, I have oil, and I have copper. And they are all on the 1 minute time frame. But I'm going to look at them on slower time frames because I know there have been a few comments about gold, and I'm sure it goes as no surprise, been on a tear. And we've also had some major reactions. Now, what's interesting is that this chart, in many ways on the 1 minute, mirrors the daily chart. So I'm going to just change this to the daily, because you may or may not have seen the post that we did. I can't remember if it was Anna or myself did it now, on gold. And this is the daily chart, and in particular volatility and particular trap moves, and where is gold heading next. And no surprise to see it's up this morning, gapped up, quite a healthy amount. It'll be interesting to see how that volume completes on the day, as to whether that is going to hold at that level or whether it's going to track back and reverse, because as I'm sure you know, gaps get filled. They get filled all the time. And on days like today, I'm afraid you've got to think like a market maker. And whilst everyone will be expecting the markets to collapse and for assets like gold to go up, which they have done so far, and for currencies to be in demand, such as safe haven, dollar, yen, Swiss franc. We'll have a look at those in a moment. Whilst that may well be true initially, what the market makers will also be well aware of is the fact that many traders will be going into this with an opinion that war is bad for the markets, and therefore everyone should be short. And if you're a market maker, you will tend to do the opposite of that, because you'll trap everyone into weak positions and make a ton of money for yourself. So you've got to think like a market maker. And if you've seen these events play out in previous phases of market reactions, then the market, where rightly or wrongly, is now becoming inured to such events, whether global or local. And whereas in the past, maybe 10 or 15 years ago, you could say, well, a global war or a global conflict of such scale would certainly cause the markets to panic, and panic big time. That no longer is the case. And the market makers will take every opportunity to trap you into a weak position, certainly from a longer term perspective at any rate, and probably intraday also. So stop thinking like a trader and start thinking like a market maker would be my advice. This is the daily chart for gold, which, as I say, mimics it's a very close replica of the 1 minute. And the candle that we pointed out that I think it was in the video was really this candle here, a massive move, huge volatility candle. And you can imagine the number of traders going short off that period, because gold is now topping out. It's had a long run. It's come from $1,000, $1,500. We're now at $5,500. That's it. End of trend. And I'm going to sell heavily, and in whatever way, whether it's futures, options, whatever it might be. But when you look at the volume associated with that candle, it's ridiculous, because the amount of that move, you only have to look at some of these volume bars over here associated with this amount of price action. And as Anne had mentioned, benchmarking. It's exactly what VPA is all about. It's about benchmarking. It's about trying to get a yardstick, a measure of whether volume and price are in agreement, and whether it's realistic. In other words, is volume in agreement with price, or is it anomalous? And this is clearly anomalous, because the price action is vast, it's huge, it's dramatic, and yet the volume doesn't replicate that at all in any way, shape or form, however you measure it. Even if you just looked at this as a mere casual 101 observer, you would say, well, it looks a bit odd, because the volume here in the upside was for this candle. We've got this massive down move, and the volume is only here. And look at the volume over here. It's ridiculous, absolutely ridiculous. One look at that would tell you that this was a trap move, by the market makers and big operators. They're not going to participate. They are simply moving the market down here on the news, and therefore in due course will reverse it fairly quickly, which is what's happened. And you can imagine a lot of traders will have lost money because they've gone short and they're now trapped or taken out. Simple as that. And if you don't like the way the game's played, then you've got to get out of the fire, because this is what it's all about, and it is what volume price analysis does. It gives you the inside track. It tells you what's going on behind the price action. And it tells you whether the market makers, big operators, insiders, what they are doing. Are they participating? Are they trapping? Are they not participating? And that's really, in essence, what volume price analysis is all about. It gives you the edge, it gives you the insight, and it is the only way that you will ever know what they are doing and where they are going next. It's as simple as that. Where's gold heading next? What I would suggest is that the top of this candle, when the way we use the volatility candle, let's call this our master candle, then once we break outside of that range and the top of it is roughly where we are at the moment, let's call it 5,500. Once we clear 5,500, if we clear that with confidence and we see rising volume there, then that should be good for gold, and we should see further trend development in due course. I think someone posted $7,000 in the chat there. That's not going to happen overnight. Longer term, why not? Provided it breaks above this level, this volatility candle, it looks as though it's going to, certainly propelled by today. But be careful, this gap could get closed in due course, because there will be an awful lot of people long. The market makers will like to snap that trap shut, take those people out before then taking it on up to higher levels. And the same, of course, would apply to silver. Very similar picture, as you would expect. Also, what I was also going to show you was the weekly chart for gold, just to take a slower perspective, which is what I always recommend when you're looking at these. You get a completely different perspective, and it will show you other things as well. This was obviously the trap move here. We had the reversal here to the downside, and when you get the volatility indicator, we expect one of two things: sideways or reversal. And this is what we're getting right now. We're getting the reversal and a continuation. So no reason at the moment to suppose, certainly from a volume perspective, that move has come to an end, because what you want to see, I say what you want to see, what you will be looking for, is something like this. We had a very nice move up here over several weeks, nice and steady, nice and even pace. Then the price action starts to widen and we get a ton of volume coming in, and even higher volume here, huge amount of volume, and yet the market didn't go anywhere. At the very least, it's coming to a pause point. But what's interesting is the follow through. We get a lot of volume on this candle, but really not a dramatic fall. And then the volume here is pretty high as well. But look at the compression on price. We've got a very narrow candle, nice wick to the lower body, very good volume under that candle. What's that telling you? It's telling you that the big operators, the market makers, are buying into that move. They're not going to let that fall just yet. They're not ready to reverse this trend, and on up we go. So that's on the weekly. Let's put that back to the 1 minute so it aligns with everybody else in this workspace. Pop that down. Silver's pretty much the same, and we've got volatility coming again on oil, and as you would expect, oil's been rising. We had a very nice trend on oil again, another trap move, wide volatility candle, not insufficient volume to replicate that sort of move, and it's reversed all the way. And the short traders here will have been trapped again, really squeezed. Same sort of thing going on here. Now we've got some decent volume coming in under that candle. The volatility has been triggered. Expect some sideways and a possible reversal off that in due course up on the 1 minute time frame. And all of that is, I've got this on 2 minute. You can have up to, I believe it's 7 on here. I've got, as I say, I've got gold, oil, silver, and copper. And yeah, you can have 7 plus the 1, so it's 6 plus the 1, so you've got 7 in total. And this can be a mixture of, we could have indices, we could have stocks, we've got commodities here, I've got the 4 commodities. And what the indicator gives you is just a sense of when a commodity is reaching an overbought or potentially oversold situation, whether it's the top it's overbought, whether it's the bottom it's oversold. it will also give you an idea of the strength of the trend. And for those of you familiar with the currency strength indicator, principles are very, very much the same. We're looking for strength. We're looking for strong trends with the steepness of the line. Or alternatively, if we're more aggressive, we're looking to get into a trend reversal earlier. So we're looking at the tops, we're looking at the bottoms for potentially overbought and oversold, and then jumping on board and watching that take shape. And you can see it here on oil. As I said, we had the volatility trigger. What we're looking for is one of two things, either a congestion phase, which is painful to sit through, or a full-blown reversal. And on this occasion, it looks like a full-blown reversal. We had very good volume came in under that candle, so we know the market makers and big operators are participating. And therefore, if they are participating, what we're looking for is actually a genuine move, not a trap move. And this is a full-blown reversal. The beauty of this indicator is, I'll just pop that up full size. The beauty of the indicator is it will trigger in real time. You don't have to wait. Now, on a 1 minute chart, that's not so important, but on a slower time frame, if you're on a 5 or 15, it is vitally important, and it will trigger as soon as the metric of average true range has been met. Once the price action has moved outside the average true range, because that's how the indicator works, it will fire, and it will fire before that candle has closed. So if you're on a 15-minute and you've got volatility in minute 1, it will fire, and instantly you will know what to do. If you've got profit, close out, take it, because you don't want to sit through congestion or reversal. If you're not in the market, sit, wait, be patient. It's a very simple rule we follow. You look at the ultimate low and the ultimate high of that candle. Once the price action, if you're not in the market, I'm talking of now, if you're not in the market, then you simply wait for that price action to clear either to the downside or to the upside, the ultimate high and the ultimate low, in other words, with wicks. Once it's cleared that level, either side, then you can assume that the reaction to that volatility has now been absorbed by the market, and therefore we are back to trading, in inverted commas, normal market conditions. And you can think about jumping back in. Okay? That's the power of the volatility indicator. You can find it on all the platforms. We have it on TradeStation, TradingView. This is NinjaTrader we're on, and also on MT4 and MT5. And I think from memory it's $79. It's immensely powerful. It will keep you out of trouble. Someone mentioned they were frightened of volatility. If you're frightened of volatility, you need to see it demonstrated and illustrated on your chart instantly. Whatever the time frame, doesn't matter on a 1 minute, 5 minute, 15 minute, hourly, daily, you'll see it. And even more importantly, if when you're using multiple time frames, when you see it on a slower time frame, that will carry even more weight, because weight is significant. Time is significant. The slower the time, the more significant will be the signal. So that's where we are there. As you would expect with oil, you know, we've had quite a decent move this morning. Very nice trend to trade there. Very straightforward trend, nothing particularly scary about it. We've got up to a top here. We're now coming off that top. We'll see where we go in the afternoon session. And as I mentioned, in amongst all of that, what we're looking at in terms of risk, we will be looking at, let's go and, unfortunately, I had all these charts open, then we had the power cut. So let's go, first of all, to this one. That's my little Bertie. Let's pop that one up here. These are all reloading. There we go. And what we have here is we have the three indices. We've got the YM, the NQ, and the ES on the top line. That's on 1 minute. And then on the bottom line, we've got the same three indices on 3 minute. And I've only got one indicator on here, and that's the accumulation and distribution indicator. And what that does, as you can see in all these cases, is it automatically displays support and resistance for you. And the way it does that is by the thickness of the line. In other words, very simple, very intuitive. The thicker the line, the stronger is that level of either resistance or support. You can see over here on the 3 minute for the ES, we've got this very dramatic line here. And if price comes up to that level, it's going to struggle a bit, maybe, because that is going to be a strong level of support and resistance in this case. And every time that level is tested and retested and holds, same here, then it is going to strengthen and widen. It's a bit like, oh, I can never remember the cartoon character. Who's the cartoon character who eats spinach? Popeye. Popeye eats spinach, his muscles grow. Exactly the same principle here. Every time this level is tested or a level is tested, it will strengthen and widen, and it happens in real time, so you don't have to worry about it. You don't have to draw lines anymore, and it gives you very clear indication of the support and resistance levels. Now, Anna's done the NQ quite a lot this morning. Let's just pop it up. This is on 1 minute. Let's have a look at the ES as well. Let's have a look at the ES. They are all pretty much doing the same thing as you might expect. And just to pick up on very, very simple 101. Oops, sorry, let's get rid of that. Just wanted to go away. Just wanted to pull that out a little bit. Very simple 101 VPA lessons here. What we're looking for, as I said earlier, is price agreement or price disagreement. Is volume price in agreement, or is volume and price in disagreement? Got a lovely example here. Look at this. We go up here, we break out. First candle comes along. You might look at that and think, yeah, that looks okay. Maybe a little bit too wide. And then the second candle breaks. And what do we have? We have 3 times the volume for only 2/3 of the price action. That alone is enough to give you information to say, at the very least, this trend is not going much further. It meanders on a little bit before it rolls over, but that is your early warning signal of weakness. It's as simple as that, because if that were not the case, and we had volume which was 2 or 3 times the previous candle, then this candle should have been off the top of my screen somewhere, and it hasn't. So what is happening here? What is happening, and I'll answer the question, it's a rhetorical question, but I'll answer it, is that the market makers, the insiders, the big operators, whatever you're trading, are putting in a huge amount of effort in, a massive effort gone in here, and yet the price has gone nowhere. Why? Because it tells you that from the fact that we've got this huge amount of effort gone in, and the price hasn't moved as far as it should have. In other words, it's in disagreement. It's Wyckoff's third law, a volume and price in agreement or in disagreement. They're in disagreement. Clearly an anomaly, very, very simple anomaly. And you would be waiting for the reaction to be confirmed, which is what you're looking for, which is we have this candle here, another effort to rally, and then we start to see it roll over and down we go. Not in any great dramatic way. It's not a huge price waterfall, and now we're back in congestion. But it's a very, very simple, that's a very simple 101 lesson of VPA in action. So that's the three indices where we are. And in fact, probably what I'll do is let me just pop this one up full size, look at where we are on the day. For those of you who are aware of it, then you'll know that we have been in this congestion phase for a very, very long time, since October. We have been predominantly back into cash since then. We are sitting here, we are waiting. Anna's done a lot of videos on this, so I won't go through it in great detail, but we are in a congestion phase. Today's price action with the plunge early on, we're now in a long-legged doji scenario. We've got a high here and a low here. The key for this congestion phase will be, certainly as far as the ES is concerned on the daily basis, will be a break somewhere below this level. If we break through that level and then we get down to this level, that's when you could see a breakdown in the market and a fracturing of this market and reversal into quite a serious bearish trend. But at the moment, it is holding up. It's not breaking down. And as I said, it's so easy on a day like today to look at this and think, oh, let's just go short. We've got a big major conflict going on, and therefore the market's going to be frightened to death. Everyone's going to be trading short. Not necessarily so, because the market makers will take an opposite view to trap you into that thought process, which is weakness. This is bad for the market. Well, yeah, it's not great news, but as far as the market's concerned, the market's been here before. It's pretty inured to this sort of news, and therefore don't expect the market just to roll over and, oh, it's bad news, therefore it's going to collapse. It's the same when you're trading stocks or indeed anything. It's not as simple, or fundamental news comes out, oh, bad news, market's down, good news, market's up, bad news, stock down, good news, stock up. Not always, and often it's not the case. You can get good news on the stock and it falls. You can get not so good news and it rises. It all depends on the relative nature of that news. If the news is bad but not as bad as expected, that's positive. If the news is good but not as good as expected, that's bad. That's how you have to think about it. Okay. That's on the indices. What else did I have up here? Just very quickly. Oh, let's go and have a look at the, not the VRSI. I had just the VWAP. Just see where we are on the VWAP. This is on the MQ. So this is all MQ now from 15-second right the way through to 5 minutes. So pretty fast. Let's go down to the slowest time frame, which is the 5 minute. This is the VWAP indicator, which is not just one indicator, but it's actually 5 in 1. If I click on the indicators here, and click on the VWAP there. Here we are. So this is a VWAP. It's an MVWAP, which is a moving volume weighted average. So that will do away with the fact that it starts every time the new session. So this will actually transition through. Then you've got the anchored VWAP, where you have the option to move the starting point for the VWAP wherever you wish. So you can move it around the chart if you've got a significant high or significant low that you want to attach it to. You can do that as well. There is a time WAP and also an intraday WAP, which will take you out into the slower time frames of daily, weekly, and monthly. So it's all here. It's 5 in 1. You simply select which one you want, and it will present in the same way. You have the VWAP itself, which is the center line, and then you have the outer envelopes, which are giving clues as to targets as to whether the price action you're witnessing is, if you like, in an overbought state or an oversold state. And of course, we use it in conjunction with volume price analysis to give us those turning points. But these envelopes are set at one moving average. You can set them at one standard deviation rather. You can set them at wider than that. But it's just a multi-tool indicator that you can apply in any which way you like. You've got all 5 variants in one. And again, it's available on all the platforms except for TradeStation. So this is available on TradingView. It's available on NinjaTrader. And also it's available on MT4 and MT5 with those 5 variants. I'm going to stop there and I'm going to pass over to Anna. Yeah, I think we're done now. Sorry, it's been a little bit of a bitty session today because we had the break in the middle with the power cut. So just to remind you that we have a 20% promotion running at the moment. I will put up the details on these videos anyway. But you can find the 20% discount either on the education site, that's LS 20%. You can plug that straight into the shop, and that will discount either the stock program or the Forex program directly. Alternatively, if you're interested in the indicators, just send us an email to helpdesk@quantumtrading.com. Put LS 20% either in the header or somewhere in the body of the email, and which indicators you would like to apply that to, and we can put together a bundle deal for you. Or you can have 20% off the full package price of all the indicators bundled together as they are. It doesn't matter. We're quite happy to do both. So thanks for coming along today. I'm going to get Anna now to end the session, and we will see you again. I think we'll probably be back on Wednesday, so we will see you then. So that's it from us both. Thanks for coming today, and bye for now.